is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Well, happy Wednesday morning. As you hear, I'm not Larry. I'm Kate Stalter, sitting in for Larry today while he's getting some R&R. Much needed and hopefully enjoying it. I'm sure he is. Great to be here with you today. I normally host the Small Cap Roundup on Tuesday and Thursday, so it's fun to be here today. I was listening to Basil's show, sitting in as he was he sitting in there? No, I was listening to Basil's show just prior to getting on the air here. It's weird to be here on a different time. Getting a little bit disoriented because I'm on a different day and time than I normally am. But I did hear him talking about Coors and Lululemon and some of the growth stocks that I like to follow. I do talk about the small caps on the show on Tuesday and Thursday. Coors is one of those mid caps IPOs that I follow. I do track recent IPOs. I was talking to somebody yesterday who kind of slipped a little bit and called IPOs a sector, and we kind of laughed because it's not really a sector, it's not really an asset class, but newly public companies are certainly those that are some of the market's best gainers historically, the ones you want to keep an eye on. I do run some separate screens on those, always have. So that's very much why we were kind of laughing about considering them a separate sector. But yeah, Coors is one that I've been following. And I also do track the smaller caps and the mid caps in the context of the broader market and in the context of what some of the larger growth names are doing. So absolutely, Lexion, interesting to hear Basil's take on that. Very, very interesting. Definitely agree with what he was saying there. And on Lululemon as well, some terrific observations. So just a lot of fun. That's one of the things I enjoy about being part of the crew here at TFNN. Very grateful to Tom and the rest of the crew over there for giving me these opportunities. And thanks to Tom and Larry for asking me to sit in while he's away. So obviously, as everybody listening here knows, we've got some selling today. You know, one of the things I always joke about, we've talked about this with some of the guests on the Small Cap Show, you always hear plenty of discussion looking for reasons. All the market analysts need to look for reasons for some of the market action. And of course, you know, you hear speculation about disappointing econ data, concerns that some of the banks will be downgraded by Moody's, and of course, the big reason, Sugar Daddy appears to be saying he's taking away the candy. So the Fed minutes yesterday, squashing hopes for more money printing, bit of a delayed reaction today after some of that announcement in yesterday's session. But you know, there really is always news that drives the market. That phenomenon has just seemed to be in hyperdrive mode in the last couple of years. But as we've been talking about for the past few weeks, very, very normal. We've seen some distribution on the major indexes after some terrific run-ups in recent months, so really not at all unusual to be seeing some selling at this point after a market rally. And a little correction based on the heavy volume selling that we have been seeing on the indexes. Not at all a surprise, not at all unexpected at this point. Let's see here. I found something I wanted to tell you guys about. If you don't read the blog Zero Hedge, that's zerohedge.com, cruise over there when you get a moment. It's often an interesting read. I don't agree with everything that they say over there, but it is a lot of fun. They have a graphic today with a circle, and I'll read you the elements in the circle. Market sell-off. Outlook deteriorates. Policymakers take action. Markets rally. Outlook improves. Policymakers dither. Markets sell off. So you're back to the 12 o'clock there on the circle. Markets sell off. So it's been completed. That is a pretty familiar picture these days, isn't it? And as one of the commenters on Zero Hedge pointed out, this cycle seems to happen sometimes in hours these days, not even days or weeks, never mind months. So as always, what I do, I use price and volume indicators and simple moving averages to identify buy and sell points. It's just another version of trade what you see. I love Larry's tagline there, the name of his show, because that is my philosophy as well, and I understand there are plenty of different ways to apply the philosophy of trade what you see, which is another one of the great points of being here on TFNN, that you get a lot of different viewpoints on the trade what you see. Now, it's interesting. I had the privilege yesterday, if you listen to the Small Cap Show, you know that I was away. We had a repeat yesterday. I was talking to some people about the market. I was out of town on a very quick business trip. And a lot of people that you meet are using a lot of the fundamental and economic predictions, which, to be blunt, just to be very candid, that's a way that a lot of the Wall Street analysts use to sound smart and to attract people in there because they want to just sound very smart, making a lot of these predictions, these fundamental and economic predictions. And I think a lot of investors have been trained over the years to literally buy into these fundamental and economic predictions. And, if you think about it, you've got all these different predictions out there, but the market doesn't care, does it? The market does what it does, despite what all these Mensa members and brainiacs are predicting. And don't get me wrong, a lot of these folks are very nice people. I'm not mad at anybody. I just think it's the way that people have been trained. I've taken some of these academic finance courses in grad school. I went through an MBA program, which I thoroughly enjoyed, really loved it. But one of the aspects, the only aspect to the finance training, is fundamental, an obsession with PE valuations and the need to manage portfolios by seeking low PEs. There's plenty of research out there to show that many of the best price performers are trading at high multiples before they go on to more gains. So just keep that in mind, that a PE that quote unquote seems high, or where somebody is saying that a valuation seems high, that's not necessarily going to be the predictor that a stock will go on to more gains or not. Now, I'm seeing here somebody saying the fundies have been right for 4 months. I use fundamentals as part of my my watch list, and how I determine a watch list based on stocks that are showing a good business model, a good track record. All the stocks that I mentioned earlier here that Basil was talking about as well. Lululemon, Coors, Alexion, Apple, of course. Yeah, all of those do have good fundamentals. They do have great great earnings growth, rather, and sales growth. I'm just making the point that the PE is not necessarily one of those predictors of where a stock is going to go. And that's something you hear over and over and over again. And there's just plenty of data, plenty of evidence to show that in the growth area, that a stock with a so-called high multiple is not necessarily one that you want to be avoiding. And that just seems to be really a lot of the obsession that you hear out there. Now, we do bring on, I bring on fund managers onto the show. In fact, we've got a guy that I'm looking forward to in the second half of the show today. He manages the BMO Small Cap Growth Fund. So, and I realize that most of these guys do tend to be fundamentally driven. It's harder for them to get in and out of stocks as quickly as individuals can. Individuals have a fantastic advantage of being able to be much more nimble. You can buy and sell just in one fell swoop. You don't have to be stuck in something just because you have too big a holding, and it's hard for you to get in and out of there quickly. There's just a lot of reasons. The funds have to be invested to a certain percentage. So a very different model, but it is interesting to hear some of the ones they're getting into, because very often those are the guys that start to buy at the bottom. Their buying sends the price higher. We can watch that. We can track that support and take advantage of that. So really, kind of the point of all of this, well, what I was kind of getting at there, somebody asked me yesterday what my price target was on the S&P 500. And I said that I don't use index price targets. So the person said to me, come on, people like nice round numbers. What in the world is the point of that? All the individual trader needs to do is watch the heavy volume selling on the major indexes. That is your signal that the market's going into a correction and you want to revisit your portfolio. If it misses its price target or makes its price target, I think that's a nice intellectual exercise, but it could be. I mean, I don't particularly find it interesting, but I suppose maybe some people think it's a nice intellectual exercise. Really, to be a trend follower, to trade what I'm seeing here, some analyst's price target on the benchmark index has nothing to do with how I'm going to be buying and selling stocks. So some of the conventional wisdom getting me a little grumpy. I just think there's a lot of bad information that gets out there to individual investors. I'm seeing it more and more. Part of the great thing here on TFNN is you get some absolutely up-to-the-minute information about trades from all the hosts over here, and it's just a lot of fun. So let's see here. Talking about some charts, I've got a couple more minutes here in this segment, and then we'll come back for a couple more, another segment before we bring on fund manager Patrick Gunlock in the second half of the show today. Looking at the Russell 2000, of course, taking a dive there along with everything else in the market. Let's see, holding up there above the 50-day moving average. So we'll see. We'll see if the selling is contained, but, to just a minor little consolidation across the indexes, or if we get into a little bit of a deeper correction. But as I mentioned, the previous track record of heavy volume selling in the last few weeks has indicated that it did look very, very possible that some kind of correction was coming, especially following that run-up. So let's see, some of the trend followers, interesting little article that I was looking at this morning from a couple of guys that I really admire, Gil Morales and Chris Catcher. Let's see, they're the authors of the book How to Trade Like an O'Neill Disciple. Now, they were talking about, let's see, the quote here that they have is, their article is titled, "There's More to Tech Than Apple." And what's kind of interesting about that is Apple is really, and I've heard this conversation quite a bit recently, really it's arguably more of a consumer discretionary than a tech, in the sense that if you look at a tech as a company that's making the hardware and software and some of the infrastructure from hardware and chips that goes into data transmission, storage for business or government use. From that definition, Apple is really much more of a consumer stock. So it's just kind of interesting to me that the Market Watch article they wrote talks about here a couple of recent IPOs. Let me go in here, take a look, and make sure I got the ticker right on LinkedIn, because that's one that I've been tracking as well. So I put the chart up there. We'll come back. We'll look at LinkedIn and a couple other recent IPO charts that are continuing to hold up pretty nicely despite some of the selling. I'm Kate Stalter. I'm sitting in for Larry today on Trade What You See. Stick around. We'll be back with much more after this break.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. you take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you seek to maximize your returns. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
All right, welcome back. We're in the Tiger Den talking about Microsoft. Big move down today. You know, just looking at the Dow, it's just a lot of the Dow components trading lower today. You know, again, it's just the signs were there in the major indexes that some kind of consolidation could be in the works. You know, Microsoft obviously as a Dow component, it is one of those names that a lot of people probably do hold, perhaps in mutual funds or ETF, some kind of indexed ETF. So a lot of people could be seeing it kind of indirectly in some of these portfolios, the effect of some of these. You know, as the dividend trade became popular recently, a lot of these blue chips, these dividend-paying blue chips, some of these ETFs and mutual funds have become more popular. So sure, widespread effect of some of these. Microsoft is not really a stock I've tracked in quite some time. Obviously, it did have a terrific rally in recent months. So from that perspective, if people did get in there, let's see, just looking at, why don't I put up a chart of it right here for just a moment while I'm talking about it. Let's see here. There we go. Got too many different screens up in front of me. So there you go. You can see what it's doing today. Kind of sliced that 50-day moving average, finding some support kind of right near that line. So far, that's actually okay. That's not Not too disastrous, really, looking at it from the big technical picture, is since it is finding support today right around that 50-day line. So we could end up with what is a quite orderly consolidation in this particular stock. So, okay, just taking a quick look at that one. Oh, let's see. I was going to look at when it cleared that consolidation. Let's see. Well, let me just show you something here on the chart, though, that's kind of interesting. We had, let's see, last summer, if I can get my dates here. It's hard to kind of find the right area here, but last summer it did undercut. Let me go to a weekly chart. That would probably help. What's interesting about this is it did undercut the low of its previous consolidation back here in the summer. It's kind of a little bit hard to see, but that happened right around in August over in here. It doesn't really look like it on that chart, but it did fall a little bit lower than the prior consolidation, so that would have reset some of your base count there. And then it did clear the second area over here, had a nice rally. So again, it just sort of reflects what's going on in the wider market. A lot of, don't forget, about 75% of stocks will follow the trend of the major indexes. So really nothing terribly surprising with what we are seeing today, even if it was that Fed news about taking away some of the quantitative easing, because I do think Mr. Market has become somewhat of an addict to some of that lately. So it's rather inevitable that some of that news would have had an effect. Okay, let's go back to, I want to take a look at LinkedIn, because really some of these recent IPOs are some of the stocks that I tend to track the most and do like the most. Now, this is an area that's in concern about the PE ratio being too high in this particular stock. Nonetheless, it's got a great track record of, let's see, sales growth, triple-digit revenue growth in recent quarters, good earnings growth, some terrific estimates. Let's see, for 2012, Wall Street expects 80% earnings growth, 2013, 73%. As I always say, be careful. Those can be wrong, either to the upside or the downside. The reason the estimates are useful is just because it does give you some kind of indication of the institutional confidence in a stock at any given time. So this one has been showing some good price strength. It did clear this little consolidation. I'm kind of indicating that on Tiger TV there. You can see it did clear the consolidation. May now be pulling into a new consolidation, remains to be seen. Not at all unusual for a stock to clear an area and then pull back a bit. You see that quite frequently, about maybe 40 or 50% of the time. Let's see here. Let me go to one more here. This is another one. I was mentioning that Catcher and Morales article from Money Show. Now, this is another pretty recent IPO. It's newer than LinkedIn. That's why if you're looking on Tiger TV, the chart's a little funky there because the bars only go back to, let's see, this went public in December. Okay, stay with us. We can talk about LinkedIn after we have talked to our guest today. We've got Patrick Gundlach from the BMO Small Cap Growth Fund coming up. Definitely want to talk to him. All right, stick around. We'll be right back with Patrick after this break.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations conditions, including price targets and price stops. As recently as March 21st, Market Insight subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, your ultimate trading mastery system, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
Folks, turns out my best student became my best teacher. Steve Rhodes absolutely raised my standards, and I'll guarantee he'll raise yours.
Thanks, Tom. What I've learned is that if you want more, you must become more, and that transformation, folks, that occurs the moment you decide to become a master. Now, the quickest way to mastery is through immersion, and for 2 solid days in Denver, Boston, and Tampa, I'll create a new standard of wealth for those few trader investors who have a burning desire to succeed. At my Master Trader course, I'll teach you how to create the ultimate money machine. These are the best-kept secrets in the business. Roadblocks, folks. Dabblers give up when they first appear. Stressors last just a little bit longer, but masters expect roadblocks and achieve extraordinary results when they bust right through them. I have all the benefit of knowing the type of wealth creation that I can generate for you. You don't. That's why I'm making this unconditional money-back guarantee. If for any reason you're not satisfied with my Master Trader course, I'll refund every penny. That's right. I take all the risk, and you get all the benefit. Go to the homepage at TFNN.com and sign up today.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
All right, I'm Kate Stalter. I'm sitting in for Larry today. And as I mentioned before the break there, I do like to bring some fund managers onto the show because it is the institutional buying and selling that does send stocks either higher or lower. And we as individuals have the advantage of being nimble enough to be able to follow in their footsteps. So I'm pleased to introduce today's guest, Patrick Gunlock. He is the manager of the BMO Small Cap Fund. Am I saying that the name of that fund exactly right there, Patrick?
Yes, it is. Thank you. I appreciate you having me, Kate.
Oh, absolutely, absolutely. Glad to talk to you. Now, the ticker here is MRSCX for people who want to follow along at home. And you have a 4-star rating from Morningstar. So first of all, Patrick, just tell us a little bit about how long have you been the manager over there? And tell us about the fund's objective and your investment philosophy.
Okay. Yes, I've been co-manager of the BMO Small Cap Growth Fund since the middle of 2007. I had previously worked as an analyst on that same product since mid-2004. And the objective of the fund is namely to invest in small cap growth stocks, but more specifically, the style of growth that we look for and the process that we have is seeking out companies that are showing improving growth rates. We're looking for companies that are showing explainable growth. And finally, and perhaps most importantly, we're looking for companies that are demonstrating sustainable growth. And one of the key differentiators for us in our process is that we aren't concerned with the absolute level of growth rates, but rather what we found is that the direction that growth rates are trending is actually a more important predictor of how stock prices are going to respond. So that's in short how we do things.
Hey, you know what? You're kind of breaking up a little bit, so I might ask you to repeat some of that. But maybe if you find a better place to stand or something, let me just kind of formulate another question here. I'd like you to talk just a little bit more about some of the growth metrics. Are you talking about earnings growth, revenue growth? What are you looking at in particular?
Yeah, so more often than not, we are keying in on revenue growth and or earnings growth. That being said, there are other metrics that do qualify for us. So for industrial companies, for example, we'll consider backlog and rates of growth of changes in backlog, and because that's a firm indicator of the health of the business and the health of the business going forward. Or for oil and gas companies, for example, we'll look at production growth rates or growth rates in reserves. And for us, that ends up being a more pure example and a more pure exhibitor of the strength of the underlying company as opposed to just earnings and revenues in that case.
Okay. Now, a couple things here. When you're talking about small cap, what market cap in particular are you looking at?
Yeah, so in ballpark terms, it was kind of $250 million on the low end. We actually have a liquidity threshold where we need at least $1.5 million a day of average daily trading volume. So that's what provides the low end boundary for us. And currently, up to $3.5 or $4 billion is the high end of what we'd look at for a new investment.
Okay. And are you benchmarked to the Russell 2000?
The Russell 2000 Growth Index.
Okay, great. So maybe then let's just talk a little bit right now. I want to get into some of the specific holdings, but let's kind of drill down. Let's talk about some of the sectors right now that you like, where you may be overweighted, and why, and then maybe we can talk about some of the ones you don't like. But start with some of your favorites right now.
Okay, sounds very good. And the way we look at the world and how we do things, we are purely bottom-up stock pickers. So the sector weightings and whether we're overweight or underweight is purely residual of the quantity and the quality of ideas that we're finding at any given time in that space. But if you look right now, an area where we are overweight is the energy space. There are many oil and gas companies, oil and gas producers that fit our process that we find very attractive. In spite of right now what we're effectively having a bear market in natural gas pricing with prices at close to $2 per MCF. But in spite of that, we've identified a lot of companies that are growing their oil production and growing their liquids production, and thus we think some of those are being penalized given the broader environment, but are in fact quite attractive.
And how about some of the areas right now, Patrick, just that you find, and I'm understanding what you're saying about being more of a bottom-up investor, but what sectors is that keeping you away from at this moment?
Well, I think one of the areas that we've are finding less ideas is in some of the more defensive, or at least the sectors that are deemed to be more defensive, such as consumer staples. What we saw particularly last year, starting in the spring of 2011 and going through most of last year, was a flight to supposedly quality. But what we really saw was that people were hiding, and people were looking for perceived safety, and a lot of this was in consumer staples companies, a Diamond Foods, for example, or a Green Mountain Coffee, and For us, companies like that did not necessarily fit our process of investing fundamentals, but rather people were so scared of the broader economic environment that that's where people were going to hide. And we can see that risk aversion even today, given that 10-year Treasury yields are barely over 2%. So we think that's caused some disconnects. There's particularly been a race to yield and high-yielding and high dividend-paying stocks, which we think has actually made some opportunities in companies that perhaps aren't high dividend-paying stocks that have been overlooked by the current marketplace.
Say a little bit more about that, because that's interesting, because that's something that I find comes up a lot with the fund managers I talk to, in that, I ask people, has this dividend trade gotten too crowded? And, obviously some of the big cap dividend managers will say, absolutely not, I see more potential here. How does that play out for you as a small cap growth manager?
Yeah, well, in general, we do think a lot of the higher yielding stocks have been perhaps overdone with the way those stocks have run up. That being said, there certainly are good companies. There are good stocks right now that pay a dividend, and we own a few companies that do pay dividends right now. But there's some very extreme examples out there. One I'll just throw out there was looking recently at a company that was a royalty trust, and this was a company that owns stakes in oil and gas wells, and they distribute the income from that as a dividend. And this particular example was a trust that by 2015, it'll be gone. There'll be nothing left. That stock will be zero. So all you get in the meantime.
Can you say which one that is?
It was one of the royalty trusts sponsored by Whiting Petroleum, but there are perhaps other examples similar to that. But in which case, it looks like over the next few years, investors might get somewhere between $11 and $13 in dividend payments and be left with a stock worth zero. And at least as of fairly recently, the stock was trading at $17, $18 a share. So the market right now, or recently, was willing to pay $18 to get, call it $13 back over the next few years.
And I suppose for people who are trading, they could take advantage of that, but maybe for longer-term investors, it could be a problem.
Yeah, you're right, and perhaps that is the mentality of, because right now it has a very attractive headline yield, a double-digit dividend yield, and perhaps one could think, okay, I'll invest in this now, and I'll collect a dividend payment or two, and I'll be smart enough to get out before people start worrying about it. Which that might work in the short term, but eventually there are going to be people holding the bag, and that could be painful.
Right, absolutely. There always are. Well, Patrick, can you talk about some of your specific holdings, and we can look at some of the charts for these while you're speaking?
Certainly. So one of our holdings, a leading holding of ours that we like quite a bit, is a company called EBIX, and the ticker and the company name are both the same, EBIX.
I got that up there, yeah.
Okay. And this is a company that provides software and services to the insurance industry. And while it may not be a household name, this has actually been one of the strongest and most consistent growth companies over the past decade. Just very powerful, both top-line and bottom-line growth. They've achieved this both through organic strong business trends. They've done some very smart acquisitions. It's a very well-managed company. But one of the things they're benefiting from is the fact that their customers are in the insurance industry. This is one of the last big industries that still is largely driven, and their processes are driven by paper. And so there's a very big multi-year trend here towards the digitization of the insurance processes, and EBIX is a direct beneficiary of that.
Now, I'm looking at some of the Morningstar data about your fund, and it looks like this is one of the major holdings in your portfolio.
Yes, this is one of the top handful of holdings right now, and this is a name we've owned for about 3 years, and while the stock certainly has had its ups and downs, overall it's been a very strong performer and a very big contributor to the performance of the BMO Small Cap Growth Fund.
Right. I'm looking at the chart, and I can see if you have held this for the past 3 years, you certainly are up quite a bit from that March 09 bottom.
Yeah, definitely.
Now, one thing also, I want to go on to some others, but just what's curious, not curious, just of interest too, is that, I look at a lot of these stocks with very small market caps. This one looks like it's about $840 million right now. And a lot of times these don't have a lot of institutional ownership, but this one's not bad. Looks like it has a decent amount of professional ownership, considering how small the company is.
EBIX does have a pretty strong and actually very dedicated institutional shareholding base. In this case, though, you are correct. The Wall Street coverage is almost non-existent. So that poses some challenges, and this has been a controversial name over the last few years. And one of the reasons for the ups and downs in the charts has been that this has been a fairly heavily shorted stock. Quite frankly, for reasons that we don't agree with or even understand. But that has been a dynamic, and we've used that as providing opportunities to get involved in a very attractive business at often pretty attractive prices.
Right. Well, Patrick, tell us about, we've got about 3 minutes here. Maybe you can quickly name one or two others.
Yeah, so another name, a much more recent holding of ours, is a company called Caesarstone. Ticker symbol is CSTE. So if you're pulling up a chart, it's not going to have much history behind it, but This is a manufacturer of quartz countertops. And quartz, well, a lot of people aren't perhaps aware of it. It has gotten a lot of traction in other parts of the world, Israel and Australia, for example. And whereas granite is much more popular here in the U.S., they're getting some good traction and have a lot of good growth ahead of them. So that's one name. Another name, Forest Oil, FST, an oil and gas company transitioning very rapidly towards oil and liquids production as opposed to just natural gas. They have a great asset base in various parts of Texas. Production growth has been strong, but most importantly, they have a fantastic inventory of future drilling locations, and we think that stock should be a good one going forward.
Now let me just kind of grill you a little bit about the Forest Oil in particular, because I'm taking a look at this and I do see where it has been. It made a little rally attempt. Let's see, late last year, but then it's been trending lower again. Tell me, is this the kind of thing? How do you base the decision to hang on to a stock like this? It does look to me like earnings are expected to grow in the next couple of years. Does that factor into it?
Yeah, the Forest Oil is one that has caused a lot of investors some frustration. For us, it is a very recent holding of ours. It's just really in the past few months that we've been attracted to the name. So we think a lot of investors have been frustrated by how it's performed over the last couple of years. But we really think that provides the opportunity here.
And it does seem to me, and I was talking kind of before you got on the show, I may have mentioned this to you earlier, just that, as individuals, we can jump in and out of these stocks much more quickly than you as a professional fund manager are able to do. How do you make your decisions? We've got less than a minute here, but how do you make the decision to buy, hold, or sell?
I apologize. Make the decision to buy
or hold or sell. And we got just a few seconds left.
Yeah. So the quickest reason we sell is if our investment thesis is broken. That's no questions asked. We're going to be out of the name. But buying, that's really where our research comes in. And if we see improved growth that's both explainable and sustainable, and we do our work and confirm all of that, those are the stocks we're going to populate our portfolio with.
Okay. Patrick, thank you so much. It's really been a lot of fun speaking with you. We'll have to have you back sometime. Appreciate your time today.
All right. Thank you very much, Steve.
All right. Stick around, everybody. I'll be back with the last segment here of Trade What You See. I'm Kate Stalter, sitting in for Larry.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, I just want to let you know I did give you some jewelry. My jeweler offered me about $650, but you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
I'm very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
Yeah, I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, back in our final few minutes here. Kate Stalter sitting in for Larry on Trade What You See. Okay, our guest just a few minutes ago, terrific conversation. Really enjoyed talking with him, Patrick Gundlach of the BMO Small Cap Growth Fund. I really liked the way he was very straightforward and talking about the pros and cons and of some of the holdings there. Really appreciated that. So he was talking about Caesarstone, CSTE, which is a recent IPO. I mentioned this the day it went public. Let's see here. That was maybe a couple weeks ago. Yeah, about March 23rd. I did talk about that on the Small Cap Show. And now this really, I've put up a weekly chart, and you can't see too much on there because it is so new. This is a great example of why individual investors need to follow in the footsteps of the institutional money, like Patrick there, because this has not yet, it had a huge pop. Let me see here. I'm just going to tell you, had a huge pop on March 28th, ran up to an intraday high of 1233. So now it's pulling back a bit. So you want to see what it does in this next consolidation. Obviously, investors who did jump in there early are still pretty happy because it is up from its IPO price, continuing to perform pretty nicely in that regard. But this is the case of where you want to just let it kind of find its trading character, give it a few weeks, even a few months, see how it performs, and then make the decision to get in. That's a much, much better approach for retail investors to take. And in a case like this, I think nobody's worried that they missed the Caesarstone IPO. But in the case of something like Facebook, a lot of people are going to be very, very worried they didn't get into the IPO without realizing, hey, you will have other chances to get in. You always do. Okay, let me take a look at some of the other IPOs. I mentioned that this is an area that I tend to track closely. Now, this is a Chinese company called Netkin. The ticker is NQ, Netkin. I'm not sure how you would pronounce the company name, but NQ is the ticker. It went public back in May of last year. I really try to avoid injecting my opinion into these things. And, of course, when you're looking at a Chinese small cap, what are you going to be worrying about? Accounting irregularities, potentially. There have been so many of these small Chinese companies that have just been flashes in the pan. They've run up. They've delivered great gains for investors who were able to trade them, get in and out quickly, not necessarily at the high and low. That's pretty much impossible to do, but to be able to pocket some gains, they were rewarding. But nonetheless, many of them are now delisted because there were some problems detected. So far, this looks fine. This company makes mobile security, and the chart looks good. And the fundamentals, Wall Street's still looking at some double-digit earnings growth on this one. Hopefully, some of the accounting is being more closely scrutinized in some of these names than it was in the past. Let me show you one more, a good old American firm, and some of you may know this one. Actually, firm is part of the name, Mattress Firm. This is a retailer. I've seen this one around in California and New Mexico. I believe, I'm not sure what regions of the country they're in. Obviously, I've seen them in the western states. But they are growing at a fast pace, planning to open about 100 more stores. This combination of last year and this year, this stock has been rallying to new highs. A little bit of selling today along with the general market. Very good chart on this one, Mattress Firm, so it's one that I will probably continue to look at. That's it. That's a wrap today. I'm Kate Stalter sitting in for Larry. Join me tomorrow on the Small Cap Roundup, 11 a.m. Eastern.